Yeah, very good afternoon all. So in last class we have discussed about financing. Yeah, important of financing decisions. Now today we are discussing about sources of finance. What are the sources of finance? So in the finance, we can see any kind of finance. They used to search for the finances sources. They should look for the sources. What are the available type the resources available to bring that sources to make it finance in the organizations in the companies. Let's see that what is this this overview of sources of finance. So business requires funds for various purposes such as starting operations, expanding or managing day-to-day expenses. Certainly, every business requires funds because without funds they can't do any kind of business. So for that reason, they want to start a business, they require funds. For what purpose? For operations inside. Or else expanding the business operations, or if they want to open a new branch, or if they want to export, or else managing day-to-day transactions or expenses. Maybe generally everyday organizations they have to maintain sufficient money in their account, in their hand also. Because if they don't have sufficient a spring amount in their hand, they can't run business. There is a difficulty to operate and manage it. So the sources of finance can be broadly classified into internal and external sources. So here the finance are divided into two particular um, parts, that is internal and external. What is internal, what is external? Let me see in the next slide. Here see what is internal source of finance. So here internal source of finance, these are the funds generated within the business without external borrowing. So we don't need to bring from outside. We need not to bring any funds from the outside. So we have to adjust the funds within the organizations only. So what that is a retained earnings. First one, retained retained earnings. So profits is reinvested in the business instead of being distributed as a dividend. So sometimes companies, if they get a profit, they used to divide into dividends. So instead of that, we have to reinvest instead of making distributing that dividends to their shareholders. So that time we have to reinvest again. So no interest or repayment obligations. So company generally, if you don't have any repayment or else interest obligations are there, then we can use it for reinvestment of the organization. Suitable for expansion and long-term investment. So this kind of business, this kind of funds may be useful for the expansion or else long-term investment. That is known as retained earnings. So in the retained earnings, we have to use the funds as a reinvestment. If the profits are there, just we have to reinvest it. And we don't have any obligations about interest and repayment. And also suitable for expansion and long-term investments. And other things, depreciation reserves. So funds set aside from profits to replace assets over the time. So sometimes companies have planned machinery have some depreciation. So here we have to replace it. So funds set aside from profits to replace assets over the time. So within that no, long-term plants and machineries, we have to use it for the and we have to replace it. So maybe every manufacturing company have a depreciation. So like machinery, say plant and machinery, furniture, everything. Every year that the life of the particular property or else asset value will be decrease and helps maintain financial stability. So we have to, if you are going to paying per depreciation amount, it's difficult to manage. So instead, we have to maintain financial stability. Now, sale of assets. So sometimes we have internal properties are there. So that properties we have to sell unused or absolute assets to generate funds. Sometimes some properties will be there inside. So then we don't use it for ourselves. So selling of unused or absolute assets to generate funds. So if anything unused things are else, if not useful into profit, then we have to. So here selling for short term or source fund. So if any kind of things we can also sell that for short term source of finance and reducing working capital. So improving efficiency in managing inventory, receivables and payable for free up cash. So free of cash purpose, we have to use that inventory or receivables or payables, whatever there, that we have to improve efficiency. Now, second thing, external source of finance. So what are the source of external finance? Let's see here. So these involves raising funds from outside the organization. Outside the organization. So what is that? Equity financing, that is owner's capital. So equity financing and share capital. Selling ownership stakes in the company common for preferred shares and no repayment obligation, but shareholders expect returns like dividends. And schedule for long-term capital. So here share capital, equity capital. That means we are selling ownership stakes in the company, common for preferred shares. Generally, we used to sell that our shares, maybe equity shares or preference shares. So instead of that equity shares, we can also sell preference shares. No repayment obligations. So generally, companies, if they have any repayment obligations, the shareholders expect that as dividends. So we don't see about that uh, dividends. We don't pay any kind of dividends. So that means we don't look for the repayment obligations and schedule for long-term capital needs. So it's suitable for long-term capital funds needs. What is that? We can also always look about the what is that external source of fund for long-term. So for that reason, for that purpose, we have to look at, okay, have to search, we have to identify the what is the suitable for long-term capital needs. Now, venture capital, um, so venture capital, angel investors. So venture capital angels are funds provided by investors in exchange for equity or often for startups. So any kind of venture capital angels. So what is their activity is that they have to provide the investors in exchange for equity. So equity means nothing. Equity contribution by the shareholders. We are selling our shares in by the case of IPOs, initial public offering. So here we have to exchange that equities are often for startups. And there is a high risk. There is a high risk but potential for high returns. So we can see that venture capitals are high risk but potential for high returns. And crowdfunding. So crowdfunding means we have to raise a small amount of capital from a large number of individuals through online platform. So we have to raise the funds in terms of small amounts of capital from a large number of individuals through online platform. So through online platform, we have a number of crowdfunding apps are there in India. So there are so many NBFCs are banking segment things also is there to promote or to bring out the fund to organization. So the general people they used to pay money for this thing with generations, but companies they don't bother about the general insurance. So that is crowdfunding from the public side. So it's the amount of capital from a large number of amounts, large number of individuals through online platform. So online platform they used to get the large number of amounts. So in single day, you can't expect persons those were the away. So what we have given promise to the person, hey, the thing is that the company will always limited. So the boundaries are there, organized are different. Now, debt financing, borrowed capital. So bank loans, fixed term borrowing with interest repayments. The suitable working capital as assets purchase. So debt financing. So we can also bring the debt from the outside. So that is known as debt financing. For example, banks are the one part of one of the financial instruments, the fixed term borrowing with interest payments. And the schedule for working capital or assets purchase. So if you instead of we can use we can also sell as bring the funds from the banks for long-term or short-term purposes. Debentures and bonds. So long-term borrowing instruments where companies pay periodic interest. So company generally if they bring the borrowing from the outside, they need to pay the instruments for long term. So we can also use you can also use this kind of methods, and it's suitable for larger scale financing. Yes, if there is a big size companies or large scale financing needs the debentures and bonds for long term purpose. And trade credit. Suppliers allow delayed payment for goods and services. So trade credit also one kind of external finance. So we also allow that suppliers allow to delay the payment goods and services for external purposes. Sometimes we used to give on credit basis for long term and short term financing for managing cash flows. So short term purpose. So financing for managing the cash flows. The leasing. It is a purchasing business lease asset, example, equipment and property. So equipment property purpose. So leasing instead of leasing instead of purchasing business lease assets, example equipment and properties. So we can also avoid the high uh, upfront cost, but involves periodic payments. So sometimes leasing can also we can avoid the high upfront cost. So external unexpected things cost we can avoid, but it involves a periodic payment. And factoring under invoice discounts. So selling unpaid invoices to financial institution to get immediate cash. So what are the invoice discounts are there in the future payments? So we can also unpaid invoices are there so that we can as a financial institution to get immediate cash and improve short-term liquidity. So short-term purposes, we can also use this uh, invoices in the discountings. So government under special funding. So government special funding sources. What are the special funding sources? Let's see here, grants and subsidies. Generally, sometimes, government is providing some grants and subsidies for the stick industries or companies for long-term, large scale industries. So governments, they provide by the governments to support to specific industries or initiatives, some kind of, sick industries, or else any kind of, um, weaker section industries, they will get the grants and subsidies from the government side. And microfinance and self-finance, self-help groups. So small loans for entrepreneurs and especially in rural areas. So that is microfinance. So government also, if they are not involved in these matters, government can also allow the microfinance, self-help finance in the rural areas. And development financial institution (DBS). Institutions like SIDBI and NABARD provide the specific sectors specific funding. So like the Small Industries Development Bank of India, SIDBI also providing developmental for Sikh industries or else any kind of supporting from the government side. They are going to involve in this supporting the funds. And also NABARD, National Agriculture Bank for Rural and Development. So this kind of NABARD also provides the sector specific funding. And choosing the right sources of finances, funds. The choice of finance depends upon the purpose of funding, cost of finance, risk appetite, and the company's financial position. So the purpose of fund is using that right sources for finance is that funding short term and long term. So short term and long term purposes, the companies the companies can choose the purpose of funding. So short term and long term purpose. They used to choose the purposeful funding, finance fund, and the cost of finance. So here the interest dilution of control. So these are the cost of finance. So risk appetite. So debt increase the financial risk. So that every time the company's debt is going to be increasing, nothing at risk appetite. Risk appetite is the one kind of financial risk. For that reason, we can also bring that financial source and the company's financial position. So creditworthiness and profitability depends upon the company's position, loyalty or credibility, brand or image. So they can also get the funding from the finance other sources. Now another concept is that capital structure. So capital structure, what is that capital structure? Now you can see the capital structure refers to the mix of debt equity, mix of debt equity. So debt of mixing of debt and equity is known as capital structure. Debt means we are bringing funds from the outside. Equity means we are selling our shares. Equity or let's say preference shares. Also, we are giving the ownership. That is equity. And that a company uses to finance its operations and growth. So company uses to finance its operations and growth. So it is crucial financial decision as it impacts the company's risk, return, and overall financial stability. So if there is a capital in the companies they can use for the different kind of financial decisions. So that means that the depend on the companies, maybe sometimes the risk, sometimes that may give a return, or else overall financial stability purpose, they can use this debt and equity mixing method in the organizations because of they want to operate the organizations, they want to see their growth in future. So this is one kind of important thing. And the components of capital structure. Equity capitals, owners funds. So funds raised from shareholders, including common and preferred equity. So funds are raised from will be raised from the shareholders, including common and preferred equity. So that is the equity capital, owners cap fund. No repayment obligation, but shareholders accept dividends and ownership control. So no repayment obligations, but shareholders accept dividends and ownership control. So example, common shares and retained earnings. So components, this is one kind of component of the capital structure. So here the common shares, what are they? That we are selling to the customers or else our shareholders. So that means we are raising the funds from the public. So that is the example, common shares and retained earnings. Debt capital, that means borrowed fundings. So debt capital, nothing but the funds borrowed from external sources such as banks and bond holders, and also must be repaid with interest, increasing financial risk, but offering tax benefits. So if any kind of tax benefits is there, debt capital is going to be borrowed from the borrowed funds. And example, bank loans and bonds, debentures. So here we are bringing that debt from the borrowing debt from the where the funds borrowed from the external sources such as banks and shareholders. Hybrid capital. So hybrid capital is a combination of debt and equity. So debt and equity instruments that have features of both equity and debt. So equity and debt nothing called hybrid capital. So hybrid capital, the instruments have features and both equity and debt. Example, convertible bonds, preferential shares. So both are convertible debentures. We can also convert immediately into cash or else debt. So preferential shares also. So we can also prefer the shares from the public's side also. Our types of capital structure. So these capital, types of capital structures, nothing but equity financing dominates the structures. So high reliance on shareholders funds, low financial risk, and suitable for startups and companies with uncertain cash flows. So the suitable equity financing dominates the structures. Um, the high resales of the shareholder because we have to show that reliance, that means trust, loyalty to the shareholders. Now, debt financing uh, dominates. Now, balanced capital structure. So, the mix of equity and debt. So, mix up equity and debt to optimize risk and return. So, most companies aim for this structure to balance the financial stability and growth. So, most of the companies, their aim is to balancing the financial stability and growth. So, every company, their main objective is to stabilize the financial position of the companies. So that is the balanced capital structure. Now we can see the factors. What are the factors affecting the capital structures? So here the cost of capital, risk and financial leverage, profitability, and the market conditions. So what is the cost of capital here? The companies are prefer the cheapest financing option. Every company they used to focus on the cheapest uh, funding possibilities. And the risk and financial leverage, high debt increases the financial risk. So companies they don't want to involve high risk. So high debt increases the financial risk. So general companies they used to avoid the high risk and profitability. Profitable firms may rely more on retained earnings. So more returns. So profits with the profitability is there, they definitely they used to focus on more profitable that may rely on the more earnings and the market conditions. So economic factors influence financing choices. So now market conditions, economic factors influence the marketing and finance choices. So the company's value increasing depends upon the market economic conditions only. Now, growth and expansion plans. It is common with growth plans may opt for external fundings. So generally, these companies they used to focus on the growth and expansion plans and tax benefits. Yes, company debt interest is tax deductible uh, and making it attractive. So companies always look about the tax benefits about their services and products. So if there is a debt, they can also show into debt portion means if there is a debt, the companies may not pay the taxes because all debts are the clearing in the case of business operations. Now, controlled considerations. So more equity means a diluted ownership. So if more equity means more shareholders are there, that is diluting um, consideration. So that dilutes maybe ownership may be dilutes into different forms. Now, what is the importance of capital structures? The capital structures ensures the financial stability and operational efficiency, and it affects the shareholders' returns and the company valuation. And they balance the risk and return to maximize the balance, the growth. So companies they used to this capital structure is balancing the risk and return to maximize the business growth only. So balancing the risk and return and maximize the business growth, and it affects the shareholders returns and the company's valuation, and it ensures the financial stability and the operational efficiency. Now another part is that capital cost of capital. So let's see what is the cost of capital. Let's see the overview of the cost of capital. Cost of capital is the minimum rate of return. Minimum rate of return the company must earn on its investment in order to satisfy its shareholders and creditors. So those who are shareholders to the company, so those who are the creditors, they are going to satisfy them with the minimum rate of returns. So companies must earn on its investment. Every company focus on the earnings. So that is the business motto, to earn the profit only. It is a crucial concept in financial management as it helps in determining the feasibility of investment projects and evaluating the performance of a company. So the cost of capital can be calculated using various methods such as weighted average cost of capital, VACC, with average cost of capital, and a dividend discount model DDM, or else capital asset pricing model CAPM. So these are the concepts under the capital assets pricing model CAPM under the cost of capital. Now, what is the definition of cost of capital? So, cost of capital refers to the minimum returns that a company must earn on its investment to maintain its market value and attract investors. So, it represents the company's cost of financing through a mix of debt, equity, and other funding sources. So, what are the other funding sources that they can see into company is going to see looking about the cost of financing through the mix of debt, equity, and other funding sources. Now, these see the cost of capital uh, formula. Here we can able to see the cost of capital is generally divided into following the components. The cost of debt, known as a KD, the effective interest rate paid by a company on its borrowed funds, loans and bonds. That's the formula. KD is equal to interest expense into one man's tax rate by total debt. So this is the formula to calculate the cost of debt. How much debt is there for the companies? How much cost is there exactly? So how that means we are going to pay how much interest we are going to pay per month per annum into tax rate. What is the tax rate we are going to pay? Maybe 12%, 30%, 18%. But total debt. So total debt. So interest amount, how much we are paying, and what is our rate of interest and total debt. So this is known as a cost of debt, and tax shields and interest repayment reduces the effective cost. Now, cost of equity. So far we see that cost of debt. Now cost of equity, the return expected by equity, say that is shareholders for provisional providing capital. So it can be calculated using capital asset pricing model CAPM. So K is equal to RF plus beta into RM minus RF, where RF is equal to risk-free rate. Risk-free rate beta is equal to uh, stock of risk related to the market. Stock of related to the market, and RM is equal to market return. So what is the market return is there? So depends upon the cost of equity, how much we are getting, and what is how much we are free from the debt. Now, cost of preferred stock, KP. So the dividend required by preferred shareholders, formula is equal KP is equal to preferred dividend by market price per share. So preferred share. So preferred share required by the preferred shareholders. Now we can able to see this shareholders formula. Now so weighted average cost of capital. Weighted average cost of capital. Now, since the companies use multiple sources of financing, the weighted average cost of capital WCC is used to determine the overall cost of capital. So WCC is equal to E by V into KE plus D by V into KD into 1 plus 1 minus tax rate plus P by V into KD, where E is equal to market value of equity, D is equal to market value of debt, and P is equal to market value of preferred stock. And also V is equal to total capital, E plus D plus P. That means market value plus equity plus debt plus preferred stock. So we can also use this formula to calculate the weighted average cost of capital. Now see the importance of cost of capital. So before this, we can see the um, importance of cost of capital. So investment decisions helps in evaluating whether an investment is profitable or not. If you are going to investing money, whether there is investable, the investment is profitable or not, we have to assess that things. There is the importance of cost of capital and the capital budgeting used to assess the projects using techniques like net present value and internal rate of return. So we are using that capital budgeting decisions for that purpose, net present value and internal rate of return, that using the assets in the case of traditional methods, in the modern method. So in valuation of firms, so investors used it to estimate the risk and return of a company. What is the risk and what is the return of a company? That investors, they used to evaluate the firms, and financial decisions helps in determining the right mix of debt and equity. So what is that right mix of debt and equity? What is the combination is there in the financial decisions? So what are the factors affecting the cost of capital? So here the macroeconomic conditions. In the macro means the entire nation, that interest rates, inflation, economic stability. The entire nation, what is our economic conditions, how much revenues we are getting from the public companies, industries. So what is the rate of interest is there? What is the inflation is there? Like that, companies risk profile. So business and risk, financial risk. So companies taking the risk profile. So and the capital structure. So mix of debt and equity. Mix of debt and equity. And industry trends. The competitive pressures, regulatory investments. So capital structure, there is a mix of debt and equity. That means how much debt is there, what is the how much equity is there inside. And industry trends. What are the industry trends are there in the company side? So let's take an example of understand how the working capital works in India. How the cost of capital uh, works in India. Suppose a company is in India is considering the investing in a new project that requires an additional investment of 1 lakh. So suppose, so if the company is required 1 lakh rupees, that is comes under the cost of capital. And the company estimates that the project will generate cash flows about 20,000 per year for the next 5 years. So the company is expecting 20,000 per year to next 20 years. And the cost of equity for the company is 12% and the cost of debt is 8%. So company has an equity 12%. That means 12% of shares they are sold in the market, maybe in the case of shareholders or else maybe equity preferred shareholders. Only 20% is the ownership from among the all own from the public side, and the rest of 88% is the bonus fund, and the cost of debt is 8%. So out of this 12%, the debt is 8% they brought from the borrowed from the external sources. So using a WCC method, we can calculate the overall cost of capital for the company. What is the weighted average cost of capital? So how much load is there in the companies? So this is one kind of example to understand how that cost of capital works in India. So with this, I'm stopping today. So in the next class, we'll discuss with another concepts.